right, Carl, thank you very much. Yes, welcome to the Halftime Report. I'm Scott Wapner. We are live today from the Future Proof Citywide Conference in beautiful Miami Beach. A few thousand wealth advisors are here, and let's just say there is a lot on their clients' minds these days. We will discuss the business that is being done down here a little bit later. First, though, the markets, they do remain volatile. We do have a pretty nice day going here, but it's been a whipsaw action over the last not even 24 hours. I've got the investment committee, several members here with me. Josh Brown is joining us today, Bill Baruch, Malcolm Etheridge, and Rob Sechin. I just told you we can show you what the majors are doing. So we are continuing to rebound, and most especially because of what you're looking at the bottom of your screen. WTI crude down almost 11%. That's the most important thing I would suggest, Josh, and I'm sure you would agree, to watch. It's been an interesting 20 hours. We had a sizable sell-off yesterday. We had the president's comments before the close, a nice reversal, and we're trying to build on it, but we're only going to build on it if crude oil remains lower, right?
Yeah, look, I think you trust the equity market here, believe it or not, more so than you trust the oil price or the commodity market. I think there's a lot more volatility on the commodity side than there is on the stock side. But the stocks related to this energy trade, they got it right. If you consider on February 11th, there was a net 76% of all of the stocks that make up the XLE index. So 3/4 of all of those stocks were making 52-week highs. And that was a full 2 weeks before we began operations in Iran. The market knew, stock investors knew. They might not have known the exact details, the exact timing, but they got that part right. And so that's what I'm focused on. You're seeing oil give back a lot, but you are not seeing a slaughterhouse in those XLE names. They seem to be holding relatively firm given the volatility in the underlying commodity.
So, Rob, what do we do with the last 20 hours? How does it formulate our views as either wealth managers or investors? But before you had the reversal yesterday, JP Morgan was suggesting you could get another 10% from the peak to trough. Pullback. Ed Yardeni had raised the odds of a market meltdown in his mind to 35%. Wolf talking about a notable spike in volatility still lies ahead. Does any of that hold anymore?
I think all of it's possible, for sure. And I think to simplify what market participants should be thinking about, specifically the clients that work with the wealth advisory community, there's those that have new money that they're looking to put to work. There's those that have capital needs, and there's those that might be overweight equities because of long-term outperformance that need to think about rebalancing. In the first cohort, those that need to put money to work, I'd say you'd be patient. You want to see how this plays out a little more. There's huge technical support at the 200-day. There's further support at the pre-liberation day highs. And those are areas that aren't that far from here where we would say you need to be a buyer. There's those that have capital needs for the year. And I would say those that have capital needs, the market has given you a chance in not fighting the White House, in believing the possibility of a benign outcome, to take advantage today and raise those funds. Rebalancing is a little more tricky. And the reason is because it has huge tax consequences. So if this ends up being transitional, that was a waste to rebalance. And so I think selective hedging to get through crisis periods using put spread collars and some interesting strategies will allow them to get to the position they want without selling into what could end up being a don't fight the White House environment.
Okay, so I want to play off of that, the don't fight the White House environment. You could call it, as Tom Lee did with me on the stage on the beach earlier this morning, the Trump put. You know, Malcolm, I want to know how we're supposed to react to that. You know, some of the policy making and the decision making within Washington has caused at times over the last year severe sell-offs in the market, okay? We've all witnessed that, but in each occasion there's been a pretty market snapback,
sure,
of a V-shaped rebound, because the belief is that there's only some degree of tolerance inside the White House for a declining stock market of any magnitude. And maybe we're learning that over the last 20 hours, as I suggested. How, as an investing class, are we supposed to deal with that? Trying to, at the worst levels of this market, at many times since April, realize that it might actually be an opportunity to buy.
I think reaction that the market is having this week so far, the whipsaw nature of it, is showing that we've been conditioned basically that just what you said, the president will gauge just how much tolerance the market has for whatever new policy action he's decided to take, and then temper his response or direction he might go from that based on what the markets give. I think in this case, we might be acting a little too complacent right now as investors, simply because the president today alone has already shown that he's looking in two different directions to gauge which stance he wants to take versus Iran. We also heard rhetoric coming out of Iran earlier today that could shift again the way that he decides he wants to respond and how long we want this hot war to go. And so I think investors might want to actually consider that this could go on a little bit longer than we've already assumed.
But why on that?
Yeah.
Are professional traders in the energy markets, when you look at futures on energy markets, 12 months out, they're 70.
Yep.
Summertime, they're 87. Why are they complacent? They know more than I think most of us know about that situation.
But I think the question Scott was asking me was more about the individual investor, right? This is more the investor class watching this and watching what's happening in oil that frankly might not even understand what oil futures are. An April contract versus a December contract. They're watching their 401k balance and they're asking the question of, should I be taking action right this moment? And my direct response to that is, I think we better wait and see.
Well, I mean, they're watching the price of gasoline as well, which goes towards a lack of tolerance in Washington for a tremendous spike in gas prices, and as well as a larger decline in the stock market. But let's not be naive to the fact that we still have largely unknown trajectory ahead for the price of oil, at least in the near term. We're not talking over the long term, but in the near term, you still have what the Wall Street Journal referred to yesterday as the most severe energy crisis since the 70s. That still exists as we wake up today, even with the reversal of yesterday and the commentary from the president.
Yeah, this is par for the course. I mean, not necessarily how we got here, but it is year 2 of a presidential cycle. There was going to be expected to be some volatility, and this is where it is. And, you know, I coming into the year, I said, we're going to have some volatility. We're going to have a sell-off at some point. We're not going to know what it is leading up to it, and it's likely going to be a surprise when it happens. And this is where we are right now. I think we come out of this fairly well in the near term, and then there could be some larger impact later this maybe around June or so. But here, I mean, going into this event, going into this war that drove oil prices up, we've already seen a tired consumer. We've had private credit fears. We've had slowing growth and firming inflation. Now it's more stagflationary. So a lot of this is getting flushed out, but we've seen corrections across different sectors. And I think it's an opportunity to think that in the near term, we're going to respond and see the market move higher.
I would tell you, without the variable of having to discuss the war and the fallout and the move in energy prices, the note today from Deutsche Bank upgrading tech and software would be the lead of many programs today, because that has been such a focal point of concern within the markets. What's been happening with the AI trade, and most especially, and quite obviously with the software stocks. Deutsche upgrades tech to neutral. All right, it's not too overweight, but it's to neutral. Software, though, is too overweight. They suggest that software companies are trading at historically low premiums versus the market. The facts are telling a different story. U.S. software companies' earnings were up 29% in the fourth quarter, and expectations for their earnings this year have been revised higher. That AI disruption worries have peaked. Now, I want to know how you feel about that, because if you take the war variable out and all of the asset classes that move as a result of that, the biggest questions hanging over this market leading into that was about the AI trade and software.
Unfortunately, and this won't be popular, but I think if we were to take the war part out of the equation, it would be, and now back to our regularly scheduled programming, which is the slow motion panic in private capital, private credit specifically, and the endless headlines about Anthropic can do this, Anthropic can do that. Here comes altruist. So that's where I think we would be. And you get this big upgrade today that you refer to. What is price telling us? These stocks are down. Palantir's down 3%, Microsoft 1%, CRM down 2%, AppLovin -6%, ServiceNow -4% on no news. Nothing's happened. None of them are reporting earnings.
They've had tremendous relative strength over the past couple of weeks.
It's a rubber band.
But how has the total journey been over the last, I don't know, 90 days? So I don't think that we've seen the last of disruption concerns. And the worst part about it is these are all great companies. Most of them are now no longer selling at a premium multiple to the S&P. The problem that they have is that you can't prove a negative. It's impossible to say, look, we weren't disrupted, because the pessimists will say, well, not yet, pal. Talk to me in a week.
That's right, because it's a matter of, Josh
right.
makes a good point. It's a matter of time, not price.
And it's frustrating.
Time is going to dictate what happens to a lot of these software companies. The answers are, to Josh's point, frustratingly unknown.
So, really good points that he's made. I think the current multiples discount that bad news. And while we're not going in wholeheartedly to the software space, we do have some exposure that we're comfortable holding. I think what's interesting right now is this stagflationary impulse has led us back to the more durable growers. Okay? So when you have a slow growth environment, you pay up for growth, and the most durable growers have gotten cheaper. So that's why I think you're seeing strength there right now, and I think that probably continues, but I don't think you can write the epitaph or the tombstone for these software names.
I agree. It's not an epitaph. It's people just saying, you know what, this is in the too hard pile. And
same with private credit, Josh, actually, same thing.
But to your point, the median trailing PE for the IGV names, the 100 or so stocks in the IGV, is 27 times, and median forward PE is 18. So cheaper. But here's the overall S&P X software, 26 times trailing, median forward 18. So not even yet at a discount, and I think that's really what the market is waiting for, and we're a ways out.
Do you know what Wells Fargo says that software stocks are now priced at from a valuation standpoint?
12 times, probably.
Department stores. Okay, they have made the link between software and department stores. The threat of AI disruption has pushed software valuations to multi-decade lows. Disruption risk largely priced in our view. The software companies deemed most exposed to AI risk now trade at a similar valuation as department stores.
Could I say, though, to that point specifically, this whole moment in software is reminding me a lot of how the internet was supposed to kill them all. All of the stores in the shopping mall were supposed to disappear. And once, 2 decades ago, internet shopping was going to kill everything. And what we ultimately saw was online shopping just made it easier for these stores to do their business. They haven't been better. So I think that we should consider, I think we should consider, though, the fact that what we're seeing is a recognition that the incumbents are going to figure it out. Microsoft isn't going anywhere. IBM's not going anywhere. These companies that earn their business helping other businesses move more efficiently and helping their employees extract more productivity, these companies aren't going anywhere.
Hey, Oracle's not going anywhere, but the stock price and the CDS have been going somewhere, right? The stock price has been going lower as the CDS has gone higher. I bring it up. It's down 23% year to date. You own the stock. Yep. They report tonight.
Yeah.
Right?
We bought more. We bought more on Friday. Late in the day on Friday. It's testing the 200-week moving average. It's down 60% from the highs. By the way, we sold it. We trimmed it at $300.
What do you want to hear from? What's the number one thing for you to stay long tomorrow that you need to hear tonight?
Well, cloud and CapEx, but what is the revenue that they're going to get outside of OpenAI? And we got to see where the money is coming in.
Didn't they just find out the flagship product they were banking on with OpenAI might not come to fruition as planned?
That was news late on Friday. And it did come off the highs pretty sharply, but it's held since then so far this week.
You're saying that you want answers on, okay, they're borrowing all this money, right, to continue the build out. You want answers on where that debt that's being raised and being spent is going to pay off.
And I do think that there is, in this environment, or the environment that we are coming from within private credit and lending, if you needed $1 million, you might be asking for $2 million, and you may not be looking to deploy it all. So I think that they're going to see the situation clean up a bit more. And I like where it is, you talked about time is going to tell us, but it's not going to be price. But right now, I do think price is what you have to watch. Again, testing at the 200-week moving average. This isn't the first move we've made in software. Last Monday, we added CrowdStrike, we added a Microsoft, a week and a half or two before that, ServiceNow. We were underweight software, and so that gives us the flexibility to step in here and expect this thing to bounce.
And by the way, they are telling you that we need to play catch up. Microsoft, underinvested, they're investing now. Amazon, underinvested, investing now. They're the smartest guys in the room around this. They are chips in on this. They don't give a about what happens to the stock price
I understand,
right now.
but being the smartest people in the room doesn't really matter.
In the short run, it does in the long run,
We learned our
Scotty.
lesson in 08. You don't think that the smartest people in the room got some stuff wrong in 2008?
There were a lot of people that got stuff wrong in 08, and by the way, in 2002. But I can tell you, those that sat on their hands in those times got eviscerated.
And I'm not trying to make a comparison in any other way between now and then. Just with the smartest people in the room stuff doesn't always work out.
It's easy to hack on the Wall Street crowd.
I'm just saying, it's not. It's just a matter of fact, right?
Yeah.
The smartest people theoretically are always in the room.
But you always have to make a business judgment as to where and when you spend the incremental dollar and how you do it. And I think if you're underspending, you're going to find yourself playing defense very aggressively.
There's another component to this, though. It's not just over and underspending. It's what are you spending on and what is the point? And I think that's the challenge that Meta shareholders wake up to. It's unclear even whether or not that particular activity will bear fruit. There's very little traction.
But why can't you fail quick, Josh? So Meta, use it as an example.
Yeah.
They got tattooed for capital spending.
4 years ago. Yeah.
22. They reined it in. They understood. They failed quickly with that. And then they reinvested again, and it's been a massive success since. If you fail quickly, redirect. I think that's the environment that we're in. I see it in my business every day. We have a policy right now that we are going to advance, and if we're headed down the wrong direction, we're going to redirect. And that's what these companies have to do.
Quickly is all relative, too. Let's not forget, Meta had to go through its worst year from a stock performance to find the religion along with Brad Gerstner's note, okay? They did that, and then the stock had its best year. So they had to go through some significant period of pain to find that. And yes, was that quick?
But
Maybe
what if they were monetizing the metaverse? Let's pretend they did. Okay, pretend they did. Would Brad Gerstner have been up there? No, he wouldn't have been.
You know what was missing at that moment, though? They were spending free cash flow to fund the build-out of the metaverse. We now have these companies, the hyperscalers included, borrowing hundreds of billions of dollars in addition to spending 100% of their
And in the case of Meta moving these leases off balance sheet so as not to make it the reality of the spend level look even worse, we also aren't sure about the strategy. Llama has been open source, does not have traction in the marketplace. It's unclear whether or not continuing to run down that road is going to have the sort of ROI that would justify. What Meta has proven, they are the best at monetizing AI
100%.
via ads. Literally the best.
Google too.
The best in the world.
The monetizers are winning.
Yeah.
Not much relief, frankly, in the market this week for these names. Ares is down 3.5, Blue Owl's down, Carlyle's down. We do have ownership on the desk. Josh, you own Carlyle, as does Malcolm, and Rob, you own Blackstone. Where do we come down today on this, Josh?
I think you look at the 4 big PE firms that are publicly traded in the S&P 500 to take your cues for what sentiment is right now. And basically, Ares negative 44% from its high, Blackstone 42, KKR 41, Apollo 31. There are 3 problems here that I can see. The first is, of course, people are worried about credit just in general. And that's obvious, and that won't just affect private capital. That'll affect the banks, too, at some point. And that's a question mark because these companies, by and large, do not have like the sort of massive credit issues that people are worried about. Hasn't happened yet. Issue 2 is a tougher one for an investor in these equities. If you thought that these companies were going to get the retail investing public from effectively 0% allocated to private equity and private credit to 5% by 2030. Those were the projections. That was the growth story. All of these stories in the Wall Street Journal and the Financial Times about redemption requests coming in above what these interval funds will allow, that darkens the outlook for the potential growth of these stocks. And what that does is it mitigates the extent to which you're willing to pay the current multiple. So right now, the asset management sector is flat. These are all substantially unflat. These are down huge.
We'll come back. All right, we're back here, future-proof Miami Beach. Let's get to some committee moves that I want to tell you about. Bill Baruch, car moves, we'll call them that. You sold Uber.
Yes, yeah, we
Stock
sold.
hasn't done well. Finally threw in the towel?
Well, be clear, it's sold in our concentrated portfolio where we own no more than 10 names. And so we have to have performance there. We really try not to outperform the market. We didn't touch in our main portfolio. And the thing is, I like the name a lot. It's 65% year-over-year free cash flow growth. It's a great story on that cash flow growth. But the problem is also we've seen outperformance come from sort of narrative names and cash flow names, and it didn't perform. You're seeing the flows turn from a tech company to an industrial. It's sort of getting repriced. So I like it, but I just don't know if it's going to perform right now, although NVIDIA GTC is coming up, and it did pop out of that last year.
All right, so just to be clear, because now I'm confused myself. You own it still in one of your portfolios.
Yes.
This is just selling it out of another.
Selling it out of our concentrated portfolio where we own no more than 10 names.
Okay.
Still 2% holding in a broad portfolio of about 40 stocks.
You still own the name.
Yes, I'm still as bullish as ever. I understand why if you have a concentrated portfolio and you need to generate, returns right this second, this is a tough name to be in because technically it's in a no man's land. It's in a pretty decent sized drawdown from the high. It has shown some support here in the low 70s, but it's unclear when people are going to want to return to this name because, of course, similar to what we were saying on the software side, there's just so much unknown about how autonomous driving will shape up, and people are not yet ready to crown Uber as the company that will unite all of the various services. I think that's how it plays out, but if I needed it to work this month or this quarter, I don't think I would keep it in a concentrated portfolio either.
All right, so Bill, you bought more Tesla.
Yeah, we swapped it out and put Tesla in there. And it's about a 6% holding now, Tesla in the concentrated portfolio. And then we added more Tesla to the name in our broad portfolio. So we bought quite a bit of Tesla. And the thing here is it's at the 200-day moving average. I think it can perform right now. Full self-driving. It was launched in South Korea in November. There's some great success there. But this is a pure AI play. I think you're seeing AI develop very fast. Even just this week, you're hearing news of brain cells playing Doom, the video game, with nothing more than being brain cells. I mean, the humanoid robots, this is where you want to see the investment perform here this year.
All right, we're going to take a break. All right, we're back live, future-proof citywide here in Miami Beach with Josh Brown and the gang, of course. And we do have your best stocks in the market. Just because we're here doesn't mean we're not going to do them.
No, got to do it.
What's the spotlight on today?
So we took a look at a bunch of large cap biotechs last year at a time where nobody was interested in talking about biotech. It just didn't fit in thematically to any of the things that were happening in 2025. But a lot of these stocks were beginning to trend higher after, I don't know, a lost decade for large cap biotech. That has all changed. Give me a chart of Amgen. This is a $36 billion a year revenue business. Again, ignored for most of the last 10 years. The stock has since broken out. I'm going to give you the risk level here. I think very comfortably you could be in the stock today. I like, let's say, the 350 area would be where I would tell you the character of the stock has changed. But here's a 50-day successful test of the 50-day 3 times since that breakout, and the 200-day is now upward sloping. So Amgen's for me, it's a keeper. I'm not personally long yet, but that may change soon. The other one quickly, ABBV, another biotech giant. Keep in mind, these stocks are incredibly halo. They're not dealing in bits and bytes. They're dealing in molecules and proteins. And the laboratories and the clinical trials, none of that can be disrupted, and all of it will be helped by AI. These are growth stocks where you don't have to worry about disruption. They're breaking out. There are more where these came from, but that's what we wanted to highlight for best stocks this week.
Rob, you own both. right?
I own both those and more than that. AbbVie, Amgen, Biotech.
Well, congratulations. Those are your best stocks in the market.
Gilead, Lilly. We noticed something very similar a while ago. If you look at the portfolios year to date, the reason they're outperforming so much is because of energy in these.
Yeah.
And we have significant overweights in each. So I agree with Josh. I think these are going to be some of the key beneficiaries of adopting and using AI to drive forward product advancement as well. And plus, if you believe in momentum, and we do, the names that are working tend to continue to work, and we think that's going to be in place for a while. Obviously, energy is a little different given the geopolitical risk that we're sitting through. That can change in a nanosecond, as we saw yesterday.
Sure.
But, thematically, we like this.
Bill, you own both of these, right?
Yeah, we own both names.
and
Amgen and AbbVie hanging right around our number 9 and number 10 positions. Amgen has had quite the year, and it was consolidating last year. A little disappointment on like their GLP competitor, but they've had tremendous revenues across their products increase. AbbVie, not the greatest earnings report about a month ago, and it's kind of been a little steady out of that, and it's consolidated for the last few months. I like AbbVie to show up in the next few as well.
All right, we'll come back. All right, we're back live at Future Proof Citywide here in Miami Beach. So this is your conference.
Yes.
You had the one in Huntington Beach, which you still do, which we come to, and now we're here. What's going on here?
Yeah, if you were suspicious, you might say I don't like being home that much. Look, this is I would say 60% of the audience that's at this event. We have 3,600 people here, mostly financial advisors and people working in asset management, wealth tech. I think 60% are at their first ever Future Proof event, and a much bigger East Coast contingent at this event than what we normally get in Huntington Beach. And that makes perfect sense. This is a very easy destination to travel to, and who doesn't want an excuse to be in Miami Beach?
What kinds of conversations are happening here among the thousands of people who are here?
3 different types of conversations happening. AI, and AI. This is every single session eventually finds its way into what does AI mean to the future of my career? How will AI help me serve my clients? What are the risks of AI to the markets, to clients? And so it makes perfect sense that we leaned into that as the theme for this year's event. We've got 1,700 companies presenting. Many of them are either established incumbents who want to show off their own AI, or brand new startups that have come along to solve problems that none of us thought would ever be solvable. And it's a really cool mix of old and new. Goldman's here. Carlyle is here, BlackRock, Invesco, Schwab, Fidelity, all of the incumbents that you know and love. And then you've got this whole crop of young people who have been experimenting with AI, building tools, building layers, and it's a very cool mix to see.
All right. Well, congratulations on the continued growth.
Thank you guys for being here.
We're happy
Thank
to
you.
be here.
Yeah.
Let's do a couple of calls, if we could, before we go. Malcolm, I'm throwing you Spotify.
Yeah.
It was named a top pick today at Morgan Stanley. They reiterate their overweight. You own the name.
Yeah, I say welcome to the party. That one is flexing their pricing power. I think they've increased prices on customers 2 times in the last 2 years, yet paid subscriber growth is on the rise. So if you missed the trade in the last 10 days on Netflix, Spotify is probably one for you to be paying attention to.
All right. Rocket. Josh initiated a buy. $21 is the target at Compass Point.
Yeah, look, this is a company that spent the mortgage nuclear winter making acquisitions. They bought the largest mortgage servicing company, Mr. Cooper. They also bought Redfin, which ties them even more closely in with the realtors and housing leads. And now, with this combination of assets, I think the CEO is on the right track, and what he wants to build is the dominant mortgage to housing platform.
One more. AT&T outlines $250 billion U.S. investment plan to boost infrastructure. Bill, you own that name.
Yeah, everybody talks about AI, and everybody talks about the need for power. Well, how do you get the power to the AI? And I mean, the AT&T is going to connect it all. They're investing quite a bit, and the stock has performed pretty well the last 2 years. I think it's going to be a great move here.
All right, we'll step away. We'll come back. Let's give you a market check before we get out of here today. You do have a pretty nice rebound across the board. Dow's good for almost 300. Most important chart of the day, there's no question, bottom of your screen. It's WTI, which is now down by 13%. Still north of $80 a barrel, but nonetheless, it is not even close to where it had been trading, and that's brought some relief on Wall Street, as you can clearly see. We're going to run it back at 3 o'clock on Closing Bell from here, Future Proof. Tom Lee, Dan Ives, Adam Parker, Brian Levitt. We'll have Liz Thomas joining us as well. I hope all of you will be here, too. We'll see what happens in a last hour of trade. It's been volatile of late. We'll see if that repeats itself today. Let's do finals, though. Robbie, what do you got?
Broadcom, think it's a rotation back to AI.
All right, well, it is green. It is green on a board of otherwise red. Malcolm?
Yeah, I'm going to reiterate Spotify. Subscriber growth is up. Great time to be getting in.
Who's App Lovin'?
I'm App Lovin'. It's down 8% today. It's back below 500. I mean, this name has been quite volatile, but machine learning, advertising, and great margins.
It's been, I mean, one of these software names that's been disrupted, to say the least, at least from a stock price standpoint lately, right?
Yeah, great opportunity, though, I think, down here for sure.
All right, and then finally, Josh Brown, what do you have for us?
I remain long Uber, reiterating my earlier comments. I think the stock is way too cheap, 16 times earnings. It's just gotten absurd at this point.
All right, so you've had a nice move in the market, NASDAQ as well, and we'll continue to track that as I see a fair amount of green today with that big splot of red, and that's oil prices, but I'll see you at 3 o'clock. Kelly, thank you very much. Welcome to Closing Bell. I'm Scott Wapner, live once again from Future Proof here in Miami Beach. The story of the day, no doubt, this rebound in stocks, but it is a fast-moving market. It is volatile yet again as we begin this final stretch. We're showing you where we stand. We are well off the best levels of the session. Oil, clearly a big story. Yes, it's lower by more than 11%. It was down a lot more a short time ago. There are some fast-moving developments there as well, and we'll get to that in just a moment. We did start moving lower in oil from the get-go. Stocks were certainly up off the jump. If you take a look at what the sectors are doing, you had a really good day. Only 2 sectors were in the red. Now that picture has changed as well. I'll discuss all of this with our panel, whether you can trust the bounce in stocks today. It's been another volatile day on Wall Street, about 20 minutes to go. We'll see if we can close positive now, because we are mixed. Tom Lee of Fundstrat, the co-founder, chief strategist, joins us now here at Future Proof. You're a brave soul wearing a suit and tie here on the beach, but it's how you roll, Tom.
Yeah,
Welcome.
I guess that's being a contrarian, right, Scott?
Yeah, well, I tell you, you sort of are. Now, you're not negative on stocks, but you do have a base case that at some point this year we're going to go down 20%, that we're going to have a bear market. Was this the first whiff of that?
Our take is we do expect that decline to happen when markets don't respond to good news. So I think we're in a period where we had a bear market already in software, the Mag 7, and in crypto. I think that's already taken out a lot of speculation. So to me, I think our bet would be markets are actually going to lift through the end of the month, that we're going to actually be positive for March and maybe hit 7,300. Later in the year is when we think a bear market might show itself.
What about oil? Right, we're watching it so closely. We're driven by headlines, some of which are apparently erroneous. I don't know what do you do with that?
Yeah, I mean, it's a very confusing time. I think it's very difficult if someone's trying to trade both the headlines or trade oil. But if I look back at the last 2 days, oil's $15 higher than it was last week, but the S&P's higher. So to me, the market actually is handling higher oil prices better. And we wrote in our note this morning that we think higher oil prices are actually good for the U.S. stock market.
Yeah, see, I think that's going to be a really hard sell for people who are watching this program, like trying almost too hard to paint some bullish scenario. How in the world are higher oil prices, which then mean even higher gas prices, which mean higher jet fuel prices, and all sorts of other issues that are related to that, input costs on a whole number of other industries, how is that possibly good for the stock market?
Yeah, part of it's a relative. One, U.S. is an exporter of oil, so we net benefit as an economy from higher oil. The second is other countries are importers, so the U.S. not only looks better, but on a relative growth basis, it should outperform, which means flows back into the U.S. And the third is, as we worry about global growth for all the reasons you described, when growth is scarce, people buy growth stocks. The U.S. stock market is a growth index, so it's coming out of the rest of the world back into the U.S. So I think it's a rotation story.
All right, speaking of growth stocks, tech has been up for debate, certain parts of it more than others. We're going to get Oracle earnings after the bell tonight. You told me earlier this morning on the stage there on the beach that you think software's bottomed.
Yeah.
Why?
Well, I think software has bottomed because we tend to price in the negative risks early, which I think's happened, and we've seen the multiples come in. You know, the IGV, which is the software ETF index, has lost 5 multiple points. Now the forward PE is 16 times. So to me, you're trading this like a cyclical industry now, and I think out of that universe of 110 stocks, many actually have durable businesses. So I think you're getting paid to buy it here at 16 times.
What about the broadening trade? Where does that stand? Now, again, if we're talking about, you make the statement that higher oil prices are actually okay, or if not better, for the stock market. Doesn't the broadening trade have an issue with that? I mean, if you start worrying about the impact of higher oil prices on the economy itself, how does the broadening trade work?
I think it's a good question. And we do have to remember there's the stock market, and it's not always the economy. So I think the U.S. economy is going to have some risks for the reasons you described, which is why I think growth stocks start to look better, which is a lot of tech. And again, the U.S. is a growth index. I'd probably lean towards growth stocks outperform, which is not necessarily a broadening trade.
Let's finish with a quick one on Bitcoin, because I think it hasn't traded like many had suspected it would at times of turmoil in the market. It wasn't a safe haven play. It wasn't digital gold, so to speak. I mean, gold was gold, and gold traded well. So where does Bitcoin go from here? Is your confidence in it in any way shaken?
It's not. I mean, Bitcoin did basically break on October 10th because that was the biggest deleveraging event in the history of crypto. When gold went up, Bitcoin went down. But I think we have gone through a winter where a lot of the speculation and the leverage is gone. And I think this weekend kind of showed Bitcoin is coming back in vogue as a store of value because oil prices went up, but over the weekend, crypto prices actually surged, and Bitcoin, as you know, is holding above 70,000 now.
All right, Tom, appreciate you joining us here at Future Proof, and we will see you back in New York as well. That's Fun Stretch Tom Lee. We welcome you back with more breaking news out of Washington. I'll go back to Eamon Javers now, who's been at the White House all day for that. Eamon?
Yeah, Scott, a new social media post here from the president warning about potential mines in the Strait of Hormuz. Here's what the president wrote just a few moments ago. He says, if Iran has put out any mines in the Hormuz Strait, and we have no reports of them doing so, we want them removed immediately. If for any reason mines were placed and they are not removed forthwith, the military consequences to Iran will be at a level never seen before. If, on the other hand, they remove what may have been placed, it will be a giant step in the right direction. This coming after a CNN report in which CNN is saying that Iran has begun laying mines in the Strait of Hormuz. So no confirmation of that from the White House, but the president here requesting the Iranians to remove any mines they may have placed in the Strait of Hormuz. And all that just begs the question, Scott, of exactly how long it might take the United States Navy and other military assets to clear the strait to make it navigable for oil and other commercial traffic. Not really clear. White House Press Secretary Caroline Leavitt at the briefing today suggested that the president could order escorts by the U.S. Navy of oil ships at some point in the future, but not committing to any specific time frame for that, and saying that a post by the Secretary of Energy earlier today, which suggested that the Navy had already done that, was inaccurate, and said that at least so far, the U.S. Navy has not escorted any oil ships through the strait. Scott, back over to you.
A remarkable day in many respects on, the headlines that have come out and how the markets have reacted to what Eamon remains a very fast-changing situation. That's our Eamon Javers reporting from the North Lawn there. Let's do the market zone now and bring in Mike Santoli and SoFi's Liz Thomas. They're here to break down these final moments of the trading day. Mackenzie Sigalos is following crypto for us, and Seema Modi with that walk-up to Oracle, which reports in overtime. But Michael, I'll begin with you. I don't need to tell you and people, it's obvious. I mean, as goes the price of oil for the most part, as so goes stocks.
Yeah, for sure. And what is interesting, though, is how stocks, in terms of the S&P 500, have managed to somewhat narrow the amplitude of their moves relative to what's been going on in oil. Obviously, it's only one day. Who knows if it matters? I think it's right, or at least plausible, for investors to take
what the president said yesterday about maybe we're pretty much done with the war, as well as the IEA announcement today and other countries talking about perhaps reserve releases, simply as a signal that $100 oil is an uncomfortable place to live, and lots of effort will be made to make sure that doesn't stick around. Beyond that, the market doesn't know what to do with any of these headlines except to read its own action. So yesterday, we get down to the minus 5% level from an all-time high in the S&P. Bounce right from there. I think still the S&P and the market in general is trying to stick to the bright side of things. In other words, hang around the net just in case you get that pass that says we're de-escalating. And so that probably means we haven't necessarily discounted any kind of a bad case scenario, but maybe we don't have to. I think that's where we are at this point. It's probably a positive. Banks have hung in there today, and semis managed to get some upside progress.
It's a tough place to live in. Mike, when you are, as an investor, trying to make your decisions with war policy via social media?
Without a doubt. I mean, we're having sort of responses to unconfirmed reports of something that may or may not be happening. I think, honestly, that's why the equity market is allowing the oil market to be its beacon on this and say they're going to just sort of decide about whether the real-time shortages are there and whether, in fact, we have to have a higher price to get out more supply in the short term. The forward curve on crude is still telling you it's trending down towards 70 by the latter part of this year. Who knows if that's correct, but that right now is how the market's positioned.
All right, we'll see at top of the hour. Look forward to seeing you and Mel.
Yep.
Of the entire software space. There is likely to be a lot of disruption in the space, probably a period of consolidation, and it's going to look a lot different than it does right now, perhaps 3 to 5 years from now. But I still think that there's opportunity in software, and I think as an investor, although it's uncomfortable to buy something that has sniffed at bear market territory for a while, I think this is a good time to be legging in.
All right, we'll see you soon, Liz. Thank you. That's Liz Thomas joining us from the New York Stock Exchange, where the clapping's begun because the bell's about to ring. And we've had a day. Once again, a volatile one at that, but we're going to go out. Looks to be red across the board unless the NASDAQ can eke something out here at the finish as we all await those Oracle earnings in overtime. And I'll send it there with Melissa and Mike.
Hey, everybody. Welcome to Blue Cloud Trading. I'm George. It is Tuesday, March 10th. The time is 5:45 p.m. Eastern Time. Market is closed. And what an interesting day today in the markets. I mean, they dropped in the morning. They moved up. They dropped again. You can see the Dow was down 0.07%. The NASDAQ was also just kind of all over the place. S&P 500, it basically closed just up 0.01%. S&P 500 down 0.21%, and the Russell 2000 was down 0.1. Well, what caused this decline here around the 2 p.m. time frame? Notice that big red candle there. That happened in all indices. All right, well, let's talk about that for a moment. Basically, you heard about it on closing bell. President Trump made several aggressive posts on Truth Social today, March 10th, regarding the possible mining of the Strait of Hormuz by Iran. His comments have created a significant tension, specifically following that Iran has already begun laying these devices. Earlier, the president issued a direct warning to Tehran, demanding the immediate removal of any naval mines. His posts were somewhat contradictory regarding the current status of the mines. The threat, he warned that if the mines are not removed forthwith, Iran will face military consequences at a level never seen before. Has it been confirmed, though? That's the question. The situation is currently marked by conflicting reports between the White House and intelligence sources. The intelligence reports basically, they reported by outlets like CNN, indicate that Iran has indeed begun laying mines, with estimates of a few dozen already deployed using small, discrete vessels. The official stance, despite these reports, the president's own Truth Social post stated that the U.S. has no reports of actual mines being placed, though he simultaneously announced the destruction of the 10 mine-laying vessels. So there's a little bit of confusion there. Military action. While the destruction of the 10 vessels had been announced by the president, the Pentagon had not yet provided a separate detailed briefing confirming the specific coordinates or the nature of those vessels beyond the president's social media updates. So those comments have caused immediate volatility in energy markets. Crude oil prices, which had started to dip, reversed higher today following the news of the potential mining and the president's death, fire, and fury rhetoric. So what's going to happen now? That's the question. And what I noticed on the charts. And by the way, we're gonna take a look at a number of stocks that were discussed on today's halftime report and closing bell. You saw Tom Lee, you saw Josh Brown. We're going to look at the index ETFs. We're going to look at Mag 7 stocks like Apple, Amazon, Google, Meta, Microsoft, Netflix, Nvidia, Tesla, and about 24 items here that were just brought up, some ETFs and stocks all mixed up in here. We're going to look at the technicals and I'll explain to you why, you know, where earlier in the day oil was dropping significantly, by the end of the day, check this out. Do you see this candle here? This here for the oil K, for example, the ProShares K1 free crude oil strategy, um, it dropped during the day but found support at that Tenkan. The Tenkan is the green line, that's the 9 period, and there's the Kijunsen, the 26 period. Notice also that it kind of came right close to that 47.40 level from the weekly chart. Let's switch it over to this weekly chart here, this prior high right here. So, yeah, the weekly chart is forming a reversal type candle, but if you look at the daily, this is telling me that now, all of a sudden, where we did yesterday have a bearish engulfing pattern, and this was negative, but in order for this to like actually materialize, price actually does need to close under the low of that pattern. That did not happen today. Price dipped slightly under, right around that level, and then the buyers stepped in and pushed it right up. If we look at the 5-minute chart for oil K, it all started happening around 2 p.m., like I said, right? So oil started moving up, and then what happened to the S&P 500? Let's take a look at that at around 2 p.m. Here we are, 2 p.m. The S&P 500 dropped. So my what I'm noticing here is that the markets are more than likely tomorrow to drop. Let's look at the VIX too. Check out the VIX. Okay, so here it is on the daily. Let's take a look at that daily. So today was a relatively um, docile type day. There wasn't a whole lot going on because the it actually did drop, but this did create a hammer type candle. If we switch it to a 3-minute chart, right around 2 p.m., the comments came out, and boom, look at the VIX on the 3-minute chart here starting to spike. So after hours, let's look at the after hours as well. That's important. We can do that on this platform. Okay, so let's look at the SPY. SPY is kind of it moved up slightly, moved up basically, actually just moved sideways. Let's look at the oil real quick. Let's see what that's looking like after hours. So there is more volatility there. So you can see up 2.46%. And yeah, so there was the close 2.54. And this is the post market. It's at 2.46. It hasn't really dropped much. It's around the same level. Very interesting. Very interesting what's happening. So let's get back to the heat map. Let's take a look at how the stocks actually performed today. You can see that Nvidia was up 1.16, Micron and Intel. Okay, they were up. A lot of the semiconductors stocks were up, but the software companies did not do so well. Look at all the red right there. CRM now, Intuit, Adobe, Uber. Um, Financials didn't really perform that great except for BAC and Citigroup. The healthcare stocks, we had Johnson Johnson up slightly, Gilead, Pfizer, Vertex up quite a bit today, 8.31%. And then as far as energy stocks, they were down, but again, they did start to spike up. Here's the ETF, and let's take a look at the ETFs real quick. So you can see that gold finally started to move back up again, 1.13%. Silver was up 2.34. Oil up 1.47. USO, United States Oil Fund. Um, Very interesting what's happening right now. But the XLE was down 1.28%. XOP was down. Let's take a look at XLE real quick. I'm just kind of curious to see what that looks like here on the charts. On the daily chart. There we go. So yeah, as a sector, energy did end up closing down for the day. Anyway, let's start off first with taking a look at the groups, and we can see that basic materials was up today, up 0.65%. Consumer cyclical up 0.12, but everything else was down. And for the 1 week, performance technology has been up the most, 1.23%. All right. Now we want to take a look at the S&P 500 once again, and let's look and see what's going on here in the daily chart. Like I said, the SPY, and what's concerning. Yesterday we talked about this bullish engulfing pattern that had formed, right? But until price can actually close above the high of that candle, this pattern right here, and it didn't happen today. Okay, it pierced that level and then retracted towards the end of the day. Stayed inside the cloud, stayed under the 9 period and the 26 period with the Ichimoku indicator. So that's bearish, in my opinion. And I think that we're more likely to actually pull back tomorrow. I mean, you can't really predict what's going to happen the next day, but based on the candlestick and what's happened throughout the day here, we had that little pop up. Things were looking quite bullish when price had gotten above the moving averages, but we were still inside the cloud, and then it retracted. Let's take a look at the weekly chart too. Oops, here we go. Get rid of this here. You can see we're still technically under the 9 period, the green line right there. How about the Qs? Qs are still under the 2 moving averages on the weekly chart. We're still inside this consolidation stage on the weekly, and on the daily chart. Check this out. A very similar situation happening here. Price in the, things were looking quite bullish earlier in the day, where price got above the Kijinsen. And look, it actually did retract towards the end of the day and closed under the cloud. Here's a 3-minute chart that shows you that. Here we are at 2 p.m. Like I said, that big pullback, price dropping under the cloud. Dow Jones, same situation, the big red bar right there, and then price continued to drop. Okay. And if you look at the daily chart, a very similar situation. So this is not good. Russell 2000, a shooting star pattern. See that long wick in the small little body? Also did the same thing, right? A false breakout. It really wasn't a false breakout. I mean, it was up until that point, things were looking pretty good. And then the negative news came out. And it's the news that drive the market and the price of stocks. So that's why I think that tomorrow is looking more bearish than bullish for the stocks and more bullish for oil once again. Here's the VIX. Like I said, on the daily chart here, it dropped, but it created this somewhat bullish type pattern here. The after the pullback here, this bullish spinning top. If we look at this on let's look at 30-minute at a 30-minute. Do you see what's happening here? It came down to the 200 on the 30-minute. In those last few hours, it started to move up. FEZ, the Euro stocks. Let's look at that on the daily chart. Look at this. Another example here. So we had these, bullish candles right here, finding support at the dotted yellow line, the 200-day moving average, and look what happened. Came up, found resistance at close to the tangents, and then dropped right back under the cloud. So that's not a good sign. All right, that's not a good sign. All right, let's take a look at the Mag 7s now. We'll start off with Apple. Apple was up 0.37%. It did remain inside the cloud, but notice there wasn't a huge move here. It just moved up slightly, very, very slightly. Amazon is under the Kijinsen, under the cloud. Remember, when price is under the cloud or inside the cloud, it's not really the best time to be buying the stock. You want to wait for the breakout, generally speaking. You're going to have a higher probability trade in that scenario. Right now, we're still under all these resistance levels. Google on the daily chart moved up just slightly, 0.22%, and look where it stalled, right at the cloud itself, once again. So I'd hold off on Google for now. Meta also popped up 1.03%, but stalled right around the cloud there. There's really no direction here with Meta. I'd stay out of that one. Microsoft is still in this, look at this, embedded decline that we've been in. We've got ourselves a nice long downward trend here with Microsoft. And it looks like, based on today's candle, that we're more likely to pull back again. It was down 0.89% today. Netflix, we've been talking about how Netflix has been stalling right at the top of the cloud. Look at all these candles here. And unsuccessful in breaking through. It needs to break through. It needs to close above. It can't just have these little wicks popping up. That just represents the high of the day. That's all it is. But it's where price closes that's important. So right now it's down 1.4%. I'd stay out of that one. Netflix, obviously. Nvidia. This one too is inside the cloud, so I'd hold off on Nvidia. It was up 1.16%. There's nothing really super bullish here. The directional movement index, another indicator that I like to use, is bearish still as far as the negative DI, you know, is above positive DI. So the direction is still technically very negative here for Nvidia. But like if you look at the whole picture here, the wider picture, it's just been in a very, very long extended consolidation, right? And if you look at the weekly chart, you can see that even more clearly here. These are multiple weeks. Each one of these little candles represents 1 week. Think of how tight that range is. Now, when we finally do break out, whether it's to the upside or to the downside, it really won't matter. We're going to see the true direction of where this thing is going to go. And even on the weekly chart, the ADX has been dropping. You can see a lot of crisscrossing taking place here. So I'd hold off on NVIDIA. And Tesla, okay, so here it is in the weekly chart, showing a little bit of strength here, but on the daily chart, we're still under the cloud. I'd hold off on that as well. All right, let's go to the stocks that were talked about on the halftime report today and on closing bell. Not all of them, but a good portion of the stocks and ETFs that were discussed. And guess what? Out of those 24 stocks that I have in this list here, it's just two that got this little blue flag here on the left-hand side. Now, what is it? What does that mean? The blue flag. Why put a blue flag? That represents very bullish technicals on both the weekly and on the daily. Okay. In order for these stocks here, these two ETFs to qualify for that blue flag, what has to happen is the following. And I'm going to give you guys a quick summary of this indicator if you're new and you're not familiar with Ichimoku Japanese indicator here. Let's get rid of these lines for a moment. We're looking at oil K, for example, right now. Let me switch it to a actually I'll leave it on the daily. Leave it on the daily chart. Let me look at gold. Just want to show you guys. I want it to be really clear. The example that I use. I want it to be extremely clear. Switch it to like a weekly chart. Okay, we'll just use a weekly chart, I guess. All right, let's use this weekly chart for oil K. Um, Here's what's necessary. You need the cloud itself. Notice that this cloud here. You got two lines. The sequence span A, it's for this light colored blue line, and then the sequence span B is the purple line. So the sequence span A, you take the midpoint of these two moving averages here, and you project that 26 periods into the future, and that's where it's plotted. When that's moving up and that line is above the purple line, it's bullish. Now, in this case, it's actually going straight up, almost like a rocket. And that's because price is also moving in that direction, right? It's just moving straight up for oil. Broke through the 200. Prices have been above these two moving averages. These two moving averages are the Tankinson, the 9 period. It's the midpoint of the last 9 periods. Okay. And then Kijinsen, that's the red line there. It's the midpoint of the last 26 periods. It's slower. And we always want that green line above the red line. The dotted yellow line is the 200-day moving average. And we always want, ideally you want the price to be above the 200. It's not necessary for the Ichimoku indicator, but it's something that you may want to also overlay on your chart. Then I finally have one more thing, the Chiku span here, the fifth line, and that is essentially the current price, which is there's the closing price right there on this red candle, and it's projected 26, in this case, 26 periods into the past. If we're looking at a weekly chart, that's 26 weeks into the past. All right, so this is all 26 weeks. And if that white line is above the candle 26 weeks ago, that's bullish. So we have everything in order here. We've got single span A above single span B, Tankinson above Kijinsen, price above the moving averages in the cloud, and the Chiku span is above price. Now, on the weekly chart, you see this reversal type candle forming. Remember, we just started the week. It's only Tuesday, and this candle is still forming. So we won't exactly know what that looks like until Friday afternoon. It might end up being a bullish candle by the end of this week. On the daily chart, let's look at this daily chart. You can see the pullback that occurred. stalling right at the thing. It's in the support level. This is why I feel like there's a higher probability now that we're going to actually bounce here. And tomorrow you will see, in my opinion, oil K moving up. There's another thing that's happening here. We've got a bullish harami where yesterday we had a bearish engulfing pattern. The news today changed the outlook now for oil K, and it's actually turned it bullish. This is a bullish harami. We get a small little body, all right, following the large red candle. If you're unfamiliar with these candlestick patterns, I'll just show you guys the cheat sheet that I like to use as the candle pattern reference sheet. You can find this on my X page, x.com. I'll talk about the links in a second, but let me show you the actual pattern that we're looking at right now. There's the bullish harami right there. Okay. The large red candle followed by a small bullish one. Okay. And that is essentially what we've got here. Very, very small body. So expect that to move up tomorrow. Here's a 2-hour chart on oil K. Around 2 p.m., you can see what happened, right? Very bullish. Look at the 30-minute chart. Okay. Price is above the cloud. And so everything is still looking quite bullish here. Here's the 1-hour chart. We did have a negative crossover in the 1 hour, but the daily chart is most important, followed by the weekly chart. Okay. Weekly is always the go-to to identify the long-term trend. And then you go to the daily for more optimal sort of entry. You can even bring it down to a shorter, like, when you're really ready to like place that trade, 3-minute chart or a 1-minute chart to get into that trade. Okay, so let's look at gold. GLD, that's the other one that actually passed the test on the daily chart and the weekly chart. You can see price today for a second day is above the moving averages. And the cloud is bullish. The Senko span A is above the Senko span B. You've got Chiku span. Notice this is the first day where Chiku span got back above price, right? White line. You can see the last few days here. Last 3 days, it was actually under or inside of it. So this is really bullish for gold. I think that what we're forming here, it looks a little bit more like a symmetrical triangle. Once again, we got another symmetrical triangle. You can see that right there. Just go ahead and draw this. I think that's what we're looking at here. We're looking at a very a range that's been developing here within this triangle, and we'll see which way it goes. If it's going to break through soon. Here's a weekly chart for you. Yeah, that certainly does look like a pennant type pattern. It's a bullish pattern. We had it back here, and you can see what happened when price broke above. So I think gold is more than likely to actually continue to the upside here. We're currently above 470.06. So we'll see what happens. Now, they also talked about Bitcoin briefly. Tom Lee likes Bitcoin still. I don't think this is the time to be adding positions in Bitcoin. I don't agree with him that the stock market's going to be up this month for the month of March. I think oil is going to be the leader throughout the whole month of March, actually, most likely, based on these new predicaments and in the news. I think that we're going to see a lot more higher prices in gas and oil throughout this month, and that's going to basically have a huge impact on everything, an impact on the economy itself. So it's just my perspective, right? Everyone's got their own perspective about what they think, where they think the market's going. Nobody can predict the market, but it's not looking bullish to me. Here's Bitcoin. It's under the cloud still. It was up 1.48%. Here's the weekly chart. Yeah, it's been stalling. It's been stalling in this little range. But look how long it's been under the cloud here for a little bit. It broke through that low. We have a series of lower highs, right? And we have lower lows. So that we had that low, then this low is lower than the prior one, and this low is lower than that one. What would be necessary? We would have to see price breaking this trend right there, because it is technically, if you think about it, it's in a downward channel. Okay, That's what a series of lower highs and lower lows will actually create. And it's impossible to know when it's over until, or to know when the whole thing changes outlook until it actually breaks it at a minimum above that trend line. And then all this other resistance right above the Ichimoku cloud, the Kijinsen, the Tenkan. So I'd hold off on IBIT. Um, what else, guys? And here's the daily chart for IBIT. Okay, still very bearish. Look, the rest of these all bearish. I'm not even sure why they're bringing these up at this point. I don't understand why they're bringing these stocks up on the show. These aren't really showing that much strength. Here's a weekly chart, for example. We had a recent negative crossover here. Here's the daily chart. It's inside the cloud. It's more sideways than anything else. And Broadcom and the semiconductors have been moving sideways mostly. If you look at SMH, for example, this is the semiconductor ETF. You know, we're in a range. That's all it is. There's nothing bullish happening here. All right, next. Let's go to AT&T. And here's the weekly chart. The weekly chart is still not really that bullish yet. You can see that we actually created we have a lower high right now from this prior high. See that little downward slope right there. Tenkin's the green line is under the red line. That's bearish. The Chiku span, the white line is under this candle here, right? Um, let's see, the cloud itself is also bearish. Single span A is under single span B. But price is technically above the cloud and holding up above here. It's also kind of creating a little bit of a bullish pennant. So we might see this potentially break above and move up. Their next earnings are on April 22nd, so it's a little while from now. But this is not the right time, in my opinion, to jump in. That's the weekly chart, and here's the daily chart. What about Rocket Companies? Still in a downward channel. Not sure why that was picked as a stock that Josh Brown likes at this particular time. There's no strength in this right now. There's no positive momentum. In fact, the momentum is to the downside. If you look down below here, the ADX is moving up still. Negative DI is still above the positive DI. Nothing special happening here. And here's the weekly chart. Okay. Spotify under the cloud found resistance right here. Bearish Harami's forming on the weekly. On the daily chart, there we are. We stalled right inside the cloud and we dropped actually. Here, this was a shooting star yesterday, a reversal candle on Monday, and we're dropping a little bit today, down 2.73. We're also under the 200. You can see that 200-day moving average there. I mean, we did recently have a little bit of a move up. We did break above this high here, for example, and we did create a high, a low. So something might transpire, but I wouldn't be jumping in quite yet. BIIB Biogen. Overall, it looks pretty bullish. I mean, it's been above the cloud for like a while now, and it's continuing to move up. You can see this nice, almost like a flag type pattern, right? So I like that. And if it can break above those highs, that's going to be probably we're going to see a continuation of the upside. Here's the weekly chart. The weekly chart has recently broken through the Ichimoku cloud. That all started back here on November 21st of 2025. We moved sideways for a little while. Now we pulled back. We're finding support at the Tenkan, but we still have that level of resistance right above the 200. Overall, this is the beginning stages of something positive happening with Biogen, in my opinion. Here's the daily chart. All right, AbbVie has been pulling back. It's under the moving average Tenkan right now. Overall, I like the chart as far as the cloud looking bullish, 200 days under and moving up, but we've got resistance above here. It needs to break through those levels, in my opinion. I want to see strength in this stock first, and right now it's been just kind of hovering under that 239.29. You got Amgen, bullish, Harami. So the weekly chart looks very bullish. I like the bullish weekly chart here. That looks great. Okay, so nothing negative to say about it. A little bit of the momentum is pulled. You can see the momentum's slowing down here On the daily chart, we are currently under the Tenkan-sen. So this one is almost there. If it can break above, once again, we'll have a buy signal. Okay. So Amgen, I'm not against that much. In fact, the healthcare stocks did pretty well today. Uber as a sector. Uber is still declining. Stay out of that one. Yikes! Look at this. Uh, Here's a new leg that's forming. So when I say a new leg, a leg to the downside. So you can have legs to the upside and legs to the downside. So here's a formation of a new leg. Go back in time. So here's the leg, the first leg. Okay. So you have a pullback, and then the second leg. You have a pullback, third leg, and then it just kind of stalled here, creating like a top this level. And then once we actually dropped under these lows here, see the pullback here. So that was the first leg down. Okay, price tried to recover. Second leg, recover. Third leg, recovery, a small recovery, and now it's forming another leg. Okay, to the downside, as you can see here, broke under the Tenkan-sen. Very bearish on the daily chart. Here's a weekly chart. Under the 200-day, sorry, under the Ichimoku cloud, but still technically above the 200-day. Looking bearish though. Owl, Blue Owl Capital. I talked about that yesterday on the weekly chart. Very bearish. Stay out of that one. ARCC, that's also still declining. You can see it's in the downward channel. KKR, same thing. We have a lower low, lower high here. Same thing with Blackstone. Okay, nothing good happens here. What about the Carlyle Group? We have a lower high here. We broke through this low. Okay, last week. This is a weekly chart you're looking at. That's bearish. Aries Management, these last few weeks, we've seen a little bit of stalling. But if you look at the daily chart, I mean, it just shows you exactly what's happening. It's in a downward trend. Oracle. So this one came out with earnings today, March 10th. This is where it was at 4 p.m. All right. It was still kind of declining. Let's take a look and see what's going on after hours. Little pop up, 7.11%. Here's the 3-minute chart so you can see what's going on. See this little highlighted square box here? This is after 4 p.m. There's 5 p.m., 6 p.m. So you can see the big pop after the earnings. So that's good. I don't know if that's going to be enough to change and break the whole trend. It's possible. We did in fact stall here. We did create a slightly higher low. You can see that right there. And if you look right there, we broke this kind of triangle type situation. So that's very bullish. And the earnings coming out today, which were positive, helped to move the price up a little after hours. But you can see the high volume here. ADX moving up, positive DI above the negative DI. But the problem is all this resistance now that it still needs to clear. And this is not a particularly bullish environment for technology stocks quite yet, right? We're still embedded to the downside. Hubs is another software company, HubSpot Inc., which is that one did something similar, right? It's like there's the higher low, the slightly higher low there. It broke through that little pattern, moved up. We have the positive, sorry, the Tenkan-sen crossed above the Kijun-sen, but price now is pulling back. It's pulling back. It was down 6.11%. Everything is very bearish here still on the daily. And if you look at the weekly chart, it kind of makes sense why it's pulling back. Look at this. It stalled right at the Tenkan-sen. That's why it's critical, guys, to look at both time frames before you make a decision on buying a stock. Look at the weekly, then look at the daily chart. If both of them confirm, you have a higher probability trade. It's not guaranteed that it's going to go up, but you have a higher probability. You're going to have more bullish, you're going to have more positive trades when you're buying stocks that are strong versus weak. Because what happens when you buy stocks that are weak, that are under the cloud or under the moving averages? They can stay in that state for quite a long time. All right. HubSpot here has been declining since February 14th, 2025. It's a long time if you think about it. I mean, it had dropped 76% in 12 months. So that means your money's tied up in this. decline, and you can't put it to good work. You put it to good work by buying it when it starts to emerge out of that big. Here's another pullback, for example, big drop, and then price breaking above, you know, breaking into the cloud. That'll be the first step where you start seeing some strength in the stock, and then when it finally gets above the cloud, and you can see that led to a move about 70% in 1.7 years. So anyway, let's look at CrowdStrike. CrowdStrike is on the weekly chart breaking above the cloud this week. It's a good sign. I like that on the weekly chart. It's breaking above, but Tenkan is still under Kijinsen. That's so we don't have a good positive order here of the moving averages. Yet the cloud itself is kind of flat. And if you look at the daily chart, you've got here's what you have. You have a higher high. Price got above this prior high, but we still have a lower low from the prior low. They call that a megaphone pattern because if you draw trend lines that way, it kind of looks like a megaphone, right? That's more bearish than bullish, honestly. And you've got resistance here, the cloud. You've got the 200. This is not the time to be jumping in. I like the fact that we're seeing a little bit of more positive momentum here. The ADX is moving up, positive DI is moving up, negative DI. But this is more of a short-lived type of thing. I think once it reaches, and you can see this candle that's formed today, even though it was up 0.43%, this is a reversal candle. Tomorrow is more likely to drop. AppLovin, another reversal candle right here, stalled at the 200, dropping. This one had hit a triple bottom. There's the bottom one, bottom two, and bottom three, right? So it reached these levels here and bounced. But I'm not particularly bullish on this either. The fact that it's stalling at the 200 is very important, is a very serious situation. Here's the weekly chart under the moving averages. IGV, I keep talking about this software index fund ETF. Okay, so it stalled. It stalled at the 7610 level right here. You can see that from these lows, right? 3 times where it touched it there, and there's the 4th time, and then it bounced. But now we are getting a bearish, on the weekly chart, we're getting a bearish Harami pattern right there. So no on that one. Here's the daily chart. Yeah, this is not an indicator that this is going to definitely turn around at this point. APO also pulling back. That's Apollo Asset Management. The financials haven't been doing well at all. All right, this is not looking good either. Under the cloud, no on that one. Silver, still kind of stuck, I suppose, in this like consolidation area here. Let's increase that, make that a little bit higher to include this little candle. Basically, I'm more bullish on gold than I am on silver because prices inside the cloud with silver. But if you look at gold, oops, we are above. So I'm more bullish in gold. And gold was up 0.94. I know silver was up more, but it is more volatile as well. So you're going to see bigger declines and bigger moves up whenever silver does have a move. And that is going to do it for this video, guys. That was a pretty long video. Went over pretty much everything I think we needed to talk about today. If you guys want to get access to the members only stuff that I post, let me show you how you can do that. Right here, Blue Cloud Trading. This is my homepage, I guess, for YouTube. And the most recent members only video was posted 3 days ago. It's about a 1 hour, 7-minute video, but this is important because I go over my entire portfolio, all the trades that I placed throughout the week. It's like a summary of all the trades that I placed the prior week, explain why I bought, why I sold. And then I also provide 30 new stock ideas. So this is more of right now what we're living in is a stock pickers market. This is not like you're buying an index and you're walking away and everything's going to be hunky dory. This is definitely more of a stock pickers market. You have to be more selective. You have to be more selective about sectors and industries. And that's what I do. I go in depth on the strongest sectors, the strongest industries, and then break it down even further down to the strongest stocks. And I use technical analysis to unveil these specific stocks. I mean, we're scanning through over 6,000 stocks with the proprietary scanner that I use, and then I'm also doing just like going through manually looking through the charts, trying to find the best ones. And every weekend I share 30 new stock ideas. I go over the entire portfolio every weekend, so you can get access to all those prior weeks as well. If you want to get access to this, what you need to do is click the join button on my page, which is different than the subscribe button. It's free to subscribe, doesn't cost you a penny. And once you subscribe, don't forget to hit the notification bell. If you click the join button, this is what happens. You click this little pop-up happens, and it gives you an option of 3 different tiers: Blue Cloud Supporter, okay, and then Blue Cloud Trader. This under this level, in the top, these bottom levels, you can get access to the exclusive member-only videos that I just mentioned. All right, and you can also request 2 stocks per month or ETFs to be analyzed as a Blue Cloud trader. So under Blue Cloud Legend level, the top tier, you get some more perks. Basically, you'll have access to some of my day trading videos. You'll get a daily stock and ETF trades update. So when I do place a trade during the day, I do share those in a post, and I do it before the market closed. For example, today I posted it around 2 p.m. Eastern time. And in order to get access to it, once you become a member, there'll be a new little tab that pops up over here. It will say membership. Let me show you what that looks like. Yeah, right there. And you just click on that, and you'll be able to access the that post. And I also share like the results from my scanner. So every day I do a quick scan to see what stocks are popping up on my scanner. Again, based on the Ichimoku rules that I have for looking for strongest stocks on the weekly and daily charts. Guys, thanks for watching. Thanks for supporting the channel. Hit the like button, subscribe, and I'll catch you all in the next video.